What's up, builders? This is Raise the Bar Radio, where we talk about building wealth, raising capital, and all in all, raising the bar in your business and your life. This is the No BS podcast for capital raisers, investors, and entrepreneurs who are serious about scaling their business and living life on their own terms. I'm Seth Bradley, securities attorney, real estate investor, and entrepreneur, bringing you world-class strategies from the best in the game. If you're ready to raise more capital, close bigger deals, build a better you, and create true financial freedom, you're in the right place. Let's go. Welcome back to the best ever CRE podcast. I'm Seth Bradley, Chief Legal Officer at TribeVest. Let's talk about something most sponsors don't think about until it's too late. Raising capital is one thing, but scaling capital is another. And scaling capital across multiple asset classes through dozens and dozens of capital partners while maintaining compliance and control, that's an entirely different level of infrastructure. That's what we're seeing right now as private markets shift. Sponsors aren't just trying to close deals anymore, they're trying to build capital ecosystems so that they can scale. They're working with independent capital aggregators, they're developing structured fund-to-funds programs, they're professionalizing investor onboarding, reporting, and administration. Because once you move beyond one-off raises, ad hoc structures, they just stop working. Fragmented entities, manual cap tables on spreadsheets, inconsistent documentation and communications, unclear compliance boundaries, it's unacceptable to investors anymore. Those things simply don't scale, and you will not be successful with that approach. Today's episode is a behind-the-scenes look at what it actually takes to build that infrastructure the right way, and what happens when sponsors decide structure is no longer optional. And with that, today, we're joined by Henry Yoshida, CEO and co-founder of Rocket Dollar, and one of the most forward-thinking minds in retirement investing. From launching Honest Dollar and selling it to Goldman Sachs to now opening the door to private equity and real assets inside of IRAs and solo 401ks, Henry has consistently been ahead of the curve. This is a conversation about the future of retirement capital. Henry, great to have you on the show, man. Welcome.
Thank you very much. Thanks, Seth. Appreciate you having me on.
Absolutely, brother. I like to kick things off with a question that's kind of unique to us as entrepreneurs, and most people will be able to answer this pretty easily, but sometimes we have a little struggle with it. When a stranger asks you on the street what you do, what do you say?
I tell them, I basically start with, I'm an entrepreneur. I help people invest money, because that usually prompts other questions. So, I don't go into that like quick elevator pitch because it's not usually in an elevator. But given that quick answer of help people invest and make money prompts a continuation of a conversation.
For sure. Where does that usually lead? Because sometimes I'll say, well, I used to. It depends on my phase of life here. But I used to say, well, I'm in real estate, or I'm a real estate investor. And then they'd be like, oh, well, you're a real estate agent, right? And then, right. Turns into that. Where does your conversation go?
So usually it turns into, I explain and I clarify and I say, look, what the company I created helps you unlock the money that you already have to go invest in things that you probably didn't know you could invest in. And again, that's what Rocket Dollar does, right? Since our IRAs do private and alternative investments, I mean, it's essentially like helping people unlock their money to go into deals they didn't think they could do with that part of their money, essentially.
Totally. Yeah. What are you obsessed with right now? A lot of times as entrepreneurs, our attention gets split. What are you obsessed with right now?
So it's kind of weird. It doesn't have anything to do with, it ties into sort of the way that I am as a person, the way I think. But right now I am about to turn 49 years old. So I've been very obsessed from a health standpoint. So I'm trying to get to like a sub 10% body fat range by the age of 50. Because I looked
that's an accomplishment by itself
compared to how many millionaires there are. Like, it's harder than almost anything else to do, especially when you overlay age. So
yeah, totally. I'm 42, gonna be 43 soon. I'm starting to lose count. I'm doing 75 hard right now. I don't know if you've heard of that diet or that kind of workout regimen. and hoping to be around 12% by the time I'm done with that. But yeah, 10%, even that little bit of difference makes a huge difference.
Right. I may not like it when I get there, but yeah, I mean, this is kind of, it's all regimented, but, having a plan and a blueprint is kind of I like having that. So it helps me sort of stay focused, on things. And this is the one that I picked for this particular stage in my life right now.
I love it, man. I'll have to get an update later whenever you hit that.
Yeah.
Henry, you've built and you've scaled, you've exited companies, from Honest Dollar to Rocket Dollar now. You've worked at Merrill Lynch. When you look back, what was the moment that you realized the traditional retirement system wasn't really serving investors and folks the way it should, and you needed to do something about it? So
I have a absolutely awesome story about this one, and it ties in a way to the 401k world that will just blow your mind. But I was a really successful consultant at Merrill Lynch, and then I had a business before Honest Dollar. Those are tech businesses. Rocket Dollar is a tech business. But before that, when I left Merrill Lynch, I created a management consulting company doing the same business I did at Merrill. It was just too difficult to do it once Bank of America took over. So by continuing that business, I had a lot of access. And one of the vendors that I worked with, so major financial services company, they were flying in a guy a day early to do a dinner with other consultants, and it happened to be in Austin, but none of these companies are based in Austin. So they asked if I would just entertain the guy the night before. Because of a bad winter weather, the host company people couldn't get in that day, but the guy had gotten into town and landed. So this was a guy named Ted Bana. I was still pretty early in my career, and I was planning on doing this retirement consulting forever. I liked the money. I liked the attention. I was helping people and consulting on the 401k plans and speaking in a lot of lunchrooms. But so they asked me to host the guy, and this guy was literally, his name is Ted Bana. If you Google him or ChatGPT him now, he was the inventor of the 401k. He was an analyst at the Treasury Department who figured out the tax code section 401k could be used for this thing that we now know as 401ks, which effectively killed pensions, which was companies giving you a pension plan. Everything changed then. And so I went to dinner with this guy because I was the only one who was already in town to take him out, and he landed. So they told me to just take him wherever for dinner, whatever he wanted. And over the course of 2 hours in this dinner, he basically tells me that he wished he'd never created the 401k plan. He did it by accident. He didn't get paid because it was a part of his job as a government employee. And he said the reason why is that it created an entire industry of financial services, or an arm of it, where they could sell, high fee plans with high fee mutual funds to the average American, and then also even get those companies, the employers of those employees, to chip in. And it took away the safety net. Like, it took away the guarantee of a pension that the company supported and provided for their employees, to now putting the responsibility of turning into money managers on the average American person. And he said that, it changed. It created this basically $1 trillion industry. He didn't get paid for it, so he could have been a little bit angry about that. But it just made me think that, this system isn't, the right way. It was all designed to funnel people into 20 to 25 mutual funds offered by the same 15 to 20 companies, record kept by the same 10 to 15 providers, some of which are also the ones who create those mutual funds. I kept doing what I was doing for a few more years, but I did definitely decide at that moment that I wasn't going to just, another term I'd learned from my early manager was sit and spin. Sit and spin was, once you become successful in financial services, or maybe even a law firm, big law, that as long as you just kind of sit and spin in that chair and you're there for 20, 30 years, you'll be fine financially. You'll have a good life, you'll have a good retirement account, good equity in the firm, and so forth. But true, financially, that probably would have been a good thing, but I just decided that wasn't really my style. And somewhere around 15 years in, I decided that, just to kick the chair away. And it really started with that dinner. It made me start to think about, do I get paid too much? I literally was told by a major financial services company to spend whatever amount of money I want to take this guy out to dinner, because the next night they were going to spend $3,500 on dinner for 8 people. Which, by the way, in 2012, that's a nice dinner in Texas.
Yeah, that's an amazing story, man. I'd love to shed a little bit of light for folks that maybe don't realize that, and they're still kind of caught up in that system, right? Like, how are you actually paid as a financial advisor, a traditional one, at like, Merrill Lynch or whatever big company, there might be out there, and how is it not good for the investor themselves?
Well, things have changed a lot. So I think that now you've had the rise of independent financial advisors who, to be fair to this industry, are much more clear cut. That's the part of the industry where they have to have a disclosed, fee arrangement with their end client. So, hey, I'm going to charge you 0.5% of the assets that you have me manage on your behalf. On an annual basis and so forth. So I'm aligned with you. If your account goes up and you become a multimillionaire in your time with me, then my fees go up because it's based as a percentage. But prior to that, built in to mutual funds, there are what they were called a lot of soft dollar fees. So these are fees that the distribution sides, the mutual fund companies had built into the expense ratios that were then given to the firms, and then a revenue share portion of that was given to the end advisor. So it was pretty opaque. And because of it, you had average mutual fund fees of, let's just use 1% to make the numbers easy. 50% of it, it's all disclosed, but this is in a paper Bible thin, type of paper that you'd see in the Bible or prospectus explaining all this. So no one ever reads these things or can analyze them. But it would disclose that of the 100 basis points, 1%, 50 would go to marketing and distribution expense. And maybe of that, 1/4 of the overall 1% was given to the financial advisor for placing those funds there. So if you're placing, let's say, 1 million, 5 million, 10 million, 15 million a year with certain mutual fund companies, you got compensated really well, but you also really showed up on the radar as an agent and distribution channel for that particular mutual fund company. Hence, they would reward you with, dinners, trips, and so forth. So that's how it worked. And all these things kind of stopped, to be fair, maybe like a little bit around like 2010, but still exist, but in a much more muted form. And at the end of the day, a lot of industries operate this way. Like maybe it's the way things need to be done to get your product seen by the end customer. In this case, like retail American investors, through financial advisors who coordinate with wholesalers and distributors at these mutual fund companies, and so forth. So that still exists today. Yeah.
Thanks for your insight on that. So going back, so you're at Merrill Lynch, right? You get this amazing industry insight dropped on you. You end up staying at Merrill Lynch.
So I'd already left.
Oh, you're already past it. Okay.
Visit. Yeah. But I'm still doing the same thing. So,
sure.
I'd spent 14 years total as a consultant for retirement plans. And I was a big partner of major financial firms that offered administration of 401ks. And I was a big partner of companies who had mutual funds. Got
it. After that, what you recognized this problem in the industry. What were your next steps?
So, we talked about this. You told me some of the things you were going to ask about, but, I really thought about that. I'd been successful, had the opportunity to sell my stake in my practice, and decided to do something completely different. And came up with the idea for a retirement platform. It's basically Roth IRAs in a mobile app. So this was the beginnings. At this time, companies like Robinhood were maybe only 3 years old, and they were only doing brokerage accounts. And then there were lesser known ones, but still big today, now ironically owned by companies like a UBS or Morgan Stanley, but companies like Wealthfront, Betterment, and so forth are still around. But they were these digital wealth advisors that were starting. And so I decided to create one that would function as only Roth IRAs and position it to basically independent employees. So think like gig economy workers, think like 1099 folks who didn't have that steady W-2 job. Those people never had access to a 401k. So this was a way for them to easily put away some small dollar amounts into very low cost index funds for as little as $1 a week, in a form of a quasi-retirement account. So that's what Honest Dollar was. And it kind of just sparked, I would go to the other side, because at this point in my consulting career, I was getting hired by mid and large size companies to negotiate between like a Vanguard, a Charles Schwab, a T. Rowe Price, or an Empower on what they would charge to administer the plan on behalf of their 12,000 employees, and then helping that company determine what 20 to 25 mutual funds would be offered in the menu of that 401k plan. So this was like completely going into non-big corporate employee types and seeing if I can help them, again, an entrepreneur who creates products to help people save and make money.
Pardon the interruption, but we don't do ads. Instead, know that if you're raising capital for real estate, my law firm, Raise Law, is here to give you the expert legal guidance you need to raise capital compliantly and structure and close your deal. And if you're looking for a done-for-you fund-to-fund solution, TribeVest is the industry's only all-in-one setup and fund administration solution. Visit raise.law and tribevest.com to learn more. Yeah, totally. And what happened to Honest Dollar? You exited that company, correct?
Yeah. So, it's I'd never done this before, but we raised a round of venture funding. We met venture capital investors through our network. We met them in Austin, not in Silicon Valley, so we didn't do your typical roadshow that you might hear about. And this was kind of lucky, not a normal scenario, but they were looking to fund a deal that they thought could scale. So we got the check and the seed round, so $2 million to start the company on an idea. And we built the product, got it registered with regulators, so that was a big part. Got the application approved in the Apple App Store. We didn't do Android, we didn't have time. And by the time we were kind of ready to go to market, we needed to seek another round of funding. And at that point, the environment wasn't really good for us to do that. It would have to go into all customer acquisition. And we made the decision, the board, to just explore a sale of the company and the assets at the time. So that coincided with the time when Goldman Sachs was looking to also get into a different demographic segment through their markets division, which now still exists as mostly a high yield savings platform. But they had this grand plan to make it a full-on investment platform, and one of the things they needed was a digital wealth chassis. And I think for a big company like that, it was cheaper to find one that already had the registrations and filings done with the regulators than it would be for them to have a meeting on a yacht in the Bay in New York to decide where to start, right? So I think that's how that kind of came and went.
Yeah. At that point, why didn't you just call it a life and go sit on the beach somewhere?
Well, and I talk about this as well. So it wasn't. We were a very early stage company, and I like to joke around that, I actually described that as we kind of failed into an acquisition by Goldman Sachs in a way. I mean, we didn't have the money to go to market and really try to scale the business from a customer standpoint. So this wasn't a large dollar acquisition. I think it probably looks better from a professional standpoint, and it says something to the resilience and grit of an entrepreneur, which I think you need to basically understand that you're doing what you can to create an outcome, return money to your investors, and even if you don't, you at least tried your absolute hardest to do right by everyone that bet and believed in you. So it was a windfall, but it wasn't enough to call it a life by any means, which is hence why I started the company that I have today.
Yeah. Well, let's talk about Rocket Dollar, man. Did you launch that immediately afterwards? Were you, I know that, us as entrepreneurs, I mean, we can't just sit on the beach, right? Even if we do hit that big exit, but we just can't sit still. We're moving on to the next thing. What was the impetus to move on to the next thing, and how long did that take?
Well, the timing was actually a couple of years. I mean, there was a lot of reflection, trying to figure out what to do. And Rocket Dollar really was also reflection and an amalgamation at that point in my life of the experiences and some of the things I'd learned, both from an entrepreneurial standpoint, but also a market positioning. So, everything I've done in my career has always been financial services. I've had FINRA licenses. I started at Merrill in the year 2000. I've had my certified financial planner since the year 2004. And even that entire time throughout my career, I've only worked in a very small part of financial services related to tax advantage retirement accounts. So I'm one of these very classic, I'm a mile deep and an inch wide type of folks from a career standpoint. And so looking at why the last company didn't work and the market segment that really needed to be served and where I can compete and where, let's say, there was a lot of big blue ocean as opposed to, a lot of competitors who would just kill you right away. That's the genesis for Rocket Dollar. So that ideation stage and thinking about it and then actually launching, there's about a 2-year gap from the exit of the prior company to the starting of the new one. And it was a complete 180 because I decided then that it made more sense to go after a segment of the population who actually had money in these retirement accounts because they'd be better, more higher value customers, and think of a way where you could service them and they would pay you for this product. When you basically do investment accounts for people starting at zero, they have no ability to pay you. It's a percentage. So flipping to the other side, and the idea came about to where, what if we use these retirement accounts and help people unlock the money that they already have to go do deals that they couldn't do? And that's actually how the name of the company came about, thinking that, a rocket can take you further than a plane can take you further than a car can take you further than you can run on your feet, as an example. So, and then obviously it was tied to money. And since the last company was called Honest Dollar, I had a panoply of something dollar domain names that existed in my own online account. And kind of ran with that one after doing some analysis that there really wasn't any sort of SEO around it. But the genesis in the learning was low value customer was going to be tough to make money to be over the cost of acquisition of that existing customer. So where can you go, and where is a space where no one's really playing? And that kind of became this alternatives capable IRA. You and I both know them as self-directed IRAs. And none of the providers really went with a customer-facing, sort of tech overlay. They went with we're a trust company, and we could send you some paperwork, literally send you paperwork in the mail, or send you a PDF and you print it out, fill it out, scan it, and send it back. And this was still in 2018, which at that time, email had been around for a long time, and digital onboarding was already existing. Yeah.
How have you evolved since 2018? Have some of the other, SDIRA custodian type of companies, have they caught up technologically, or how do you still separate yourself from them?
Well, so I think right now, I wouldn't say that they caught up to us from a technology standpoint, but they're doing a good job of looking like they're tech. So redoing your website and hiring, someone on 99 Designs to create you a cooler looking logo than the one that your CEO from 1992 designed. Very easy to do, and now you can just throw up a new website. But, what really happens behind the scenes is the real automation there and so forth. So I think that from a look standpoint, they're doing a good job of playing the part. But, I like to think that, we started that way first, so we just have that advantage. It's like how, we both live in the United States, but we're obviously of descent from different parts of the world. And some parts of the world completely skip landline telephone lines, so they're completely, everything is wireless and Wi-Fi and in the air. So it's just a matter of fact when they started that dictates who they are at a foundational level. And so for us, starting as a tech first platform has allowed us to sort of be that way, while the other people, they still have to manage their landlines and try to look like tech on top of that.
Right. You're built foundationally on tech, as opposed to, they've got this old school landline foundation, and that's, they're trying to build just kind of a facade over top of that.
Right. And it's good. It worked for them, and it still continues to work. But, the problem is that 65% of your resources are dedicated to maintaining, things that no one would start today.
Yeah. Totally. I think a lot of people out there still think that retirement accounts are still just only limited to, as we had talked about before, this select group of mutual funds, maybe ETFs, things like that. What is it about these self-directed types of accounts that are different from what typical W-2s are used to investing in, maybe just through their company?
The answer that I think people expect me to give is always something related to this investment, that investment. But, I want people to understand that I think the way self-directed IRAs, grow and they really scale and they become kind of the new type of retirement account is when people understand that they can now use the monies that they've saved and grown probably in these traditional mutual fund and stock investments to go into deals that are really tangible and personal to them, ones that they can understand and analyze, right? When I was growing up, I was kind of taught that when you owned a share in a company like Coca-Cola or Walt Disney, you're a part owner in that company. So you don't go out and buy Pepsi products and you don't go visit Universal Studios. But now the stocks have all become digitized. So it's this very like intangible thing. Like there's no ownership, there's no loyalty, there's no connection to the company and so forth. So, private investments have kind of replaced that. So if someone who had accumulated monies in a mutual fund in an old 401k now leaves that company and then opens up a rocket dollar IRA to go buy a rental property in the town of their alma mater, for example, like we were talking about, I know situations of people doing that. You said you yourself, own investments in the old town where you went to college and so forth. Like that's a personal connection. Like it's either a personal connection or you have unique insight or some combination of both. And I think that self-directed IRAs allow people to kind of become their own little mini Warren Buffett, or like Sam Zell. Sam Zell would be the equivalent of a Warren Buffett in real estate, as an example. They have that unique knowledge, like they know and they can control. They can make a $25,000 investment into a buddy's private company. They can make a $50,000 investment into a syndication for a multifamily apartment complex that is on the outskirts of a town that they grew up in, for example, because they know that town is changed a lot since they grew up. So there's this personal connection. That's what self-directed IRAs are to me, above and beyond, and how they're different from just regular IRAs at regular fund and houses, because those same companies that create those mutual funds are the same ones who also facilitate the creation of the IRAs. And just like Costco, they'd rather you buy Kirkland Signature than something that's not.
Love that, man. Yeah, what I'm hearing is control, right? You gain more control over your finances, over your financial future. And why wouldn't you want to take control of your financial future and really your independence, right? We always talk about financial independence and things like that. Why wouldn't you want to take control of that? Why wouldn't you want to start analyzing deals and being able to invest in things that you believe in, that maybe you've done due diligence on, that you really like and you want to invest in? And I think there's a massive movement in investing, and there's a demand for private deals and alternative investments, and you're seeing that more and more. The SEC actually just put out a white paper about how 14.3% of accredited investors are quote unquote extremely interested in private market deals. They don't know how to get into them. And that's only, that 14% doesn't include people that don't even know what they are, right? They don't even know that they want it yet. Right. And then you're just seeing kind of like these more traditional financial advisors actually reach out to us at TribeVest, us at my law firm, places like that, where they want exposure to private deals. Like they want to know, how can I get my investors exposure to private deals? And you're just seeing more and more of that.
Right. Well, I went to a presentation the other day. There were 4 big private equity firms speaking. So like Stepstone, Apollo, Blue Owl, and Vista Equity Partners. So they had representatives from all 4. And I can't remember which of the 4 said this, but they said that now 83% of the companies that do over 100 million in revenue, which is not a large number today, are privately traded. And I've talked about this a lot publicly in news articles, but that companies today don't go public when they're small to get capital from the stock market. So Amazon.com, or at the time Amazon, went public when they were doing 30 to 40 million in revenue. So theoretically, they were able to be invested in through an E-Trade account or through your financial advisor at Merrill Lynch or Morgan Stanley or Edward Jones. At that particular time, Robinhood didn't exist, obviously, when they IPO'd, but that was at $30 million. Now you got companies like SpaceX and OpenAI that now are closing investment rounds from private institutional investors, valuing them at each over $1 trillion. So if and when they go public, it's not for them to get capital to continue growing. It's for the small group of private investors to finally gain cash liquidity. and sell us the shares at $1 trillion valuation. I mean, when they debut as public companies at some point down the road, if that happens, they would immediately be in the top 5 to 10 largest companies in the country, and past companies like Costco, like Bank of America, like JP Morgan, I mean, names that have been around literally for 100 years at this point.
Yeah.
Like, you can't invest in them anymore. So you have to go where the investments are. That's number one. I don't solve that problem, right? Other entrepreneurs are doing that. TribeVest helps facilitate that. But number two is that once you do that, unless you're one of the accredited investors you mentioned in the study you referenced, those people are defined as having money. Where do you access capital? So that's where I come in, right? Like I'm a supply person. I'm not a product side of the equation in the economic equation here. There's about $46.8 trillion tied up in U.S. retirement accounts right now. 99.2% of it's invested in stocks, bonds, mutual funds. And we didn't talk about this earlier, but there are only 3,700 publicly traded stocks in the United States now. That number is down from 10,000. Ironically enough, there's 10,000 mutual funds that are basically just value meal combos of those 3,776 stocks and bonds. So, all in all, it's a pretty limited universe, but that's where most of the money in retirement accounts are. So Rocket Dollar is less of an investment platform and more of a access to your money to go do other things that might be more personally relevant to you from a control standpoint to save and make money off of, because that's where I think the next generation is going to be.
Yeah. Is there a mindset shift that needs to happen from these investors to where they need to take control and they need to start thinking differently about not just, here, take my money and put it in these, stocks and bonds and mutual funds? Like, do you see that with some of your customers?
People that are our customers, they already see that. And, one of the things I noticed about our customers was that early on, they tend to skew a little bit more affluent. So let's say mass affluent. A lot of our customers are doing deals where they would need to attest to be accredited investors. We don't need to do that because we're just the provider of the IRA. But when you talk to them and you understand who they are, they're people that either they have a cynical view towards the stock market in that they understand that they gained wealth there because of contributing 10% of a salary in a big law 401k with a good matching system at the right particular time in history. And they realized that they only put in $200,000. The employer matched 75, and this is over, like, let's say 15 years working at a big law firm or a big corporation. And then the investment growth was another 400. So now they got 750,000-ish in the account, and realized that only 200 of what they put in is cash money. And that was over 15 to 20 years at some rate, like 8, 9, 10% of their salary, plus bonuses going in. So to open up a Rocket Dollar IRA is basically doing the equivalent of like taking those chips off the table, putting them in your back pocket so you don't go into losing what you started with and doing something else. So that mind shift, I think, already exists among our customer base. And I think more and more people will think that way. And to your point about, or your question about what the big mindset shift change is going to be, it's when people get more and more cynical that the returns of our stock market may or may not be driven by 7 technology companies are driving 80% of the earnings per share growth, all in one industry, technology, and 5 out of 7 of them had a lot of positive, let's say, sentiment and stock growth in the year 2025, which just ended, by signing multi-year contracts with a non-profitable, privately traded company called OpenAI.
Yeah.
I mean, I'm not saying that things won't continue to grow overall, but right now that's a lot of concentration. The S&P 500 is really more like the S&P 7 at this point.
Yeah. That's very true. Kind of overlay all those thoughts with this idea of democratizing alternative investments. We say that a lot at TribeVest as well. I've heard you say it. What does that really mean in practice and for investors?
Well, I never say it because it's just too long of a word, and I'm not sure if I were put on the spot, I'm not sure I could spell it out. But again, that's exactly why. So all joking aside, the democratization of the private assets, it's that you have a lot of different powerful parts of the ecosystem who are now all supporting greater and easier and more transparent access to private investments. And so when I say powerful players in the ecosystem, I'm talking about regulatory bodies, the SEC white paper that you just talked about. That was a study, but aside from a white paper that just tells you the sentiments of wealthy people, President Trump on August 4th of 2025 actually signed an executive order to allow private investments to be made available as options inside of retirement plans offered by companies. Okay, so let's say that the regulatory and executive administration environments are now starting to understand that hey, for the average American retail investor to really go and get returns over the long run, we need to make it easier for them to access these things. And as dumb an analogy as this is, I kind of feel like this is when the early days of ride sharing, they really resisted this, thinking that, well, this is going to take away from the companies that are registered that do the medallions. And then they started recognizing that people needed to get to and from an airport, get to and from and around towns and stuff like that. So they had to ease the rules, because this actually just made transportation and moving people around better than it was before. So that was the thinking. And I think the thinking is happening now from an administration regulatory standpoint, that if 83% of the companies who do over 100 million in revenue, and 100 million is a threshold that if you live in a top 75 US market, your largest heating and air conditioning company in that town probably does 100 million in revenue overall, just to give you a sense of like that's sounds big, not that big. 100 million in revenue. One Chick-fil-A does like 13 million, just one. So 100 million is not that hard of a number to hit. And then you got, let's say, actual private company and private investment issuers like private equity firms are starting to replicate the playbook of regular financial houses that produce mutual funds. Like, again, I went to that presentation. They now have wholesalers and distribution channels, and they've created versions of their fund that can be invested in not by Warren Buffett and billionaires, but by people at $5,000 and $10,000 minimum. Sometimes they don't even need to be accredited. So now you got the private issuer ecosystem trying to make it easy. Then you got the third part, which is public sentiment starting to change, that, hey, look, if all of my money is only allowed to be in 3,700 publicly traded companies, of which 80 to 85% of those earnings are driven by the same same as the $100 million revenue companies and above, then I need to be, they're asking for access to some of these private companies now as well. So you got all three working in conjunction, and it's one of those where it's going to happen. It's been happening over a long time, and then at one moment a tipping point will hit. So I think that's what's going to happen.
Yeah, totally agree. There's an intersection of technology and demand and political landscape. You hear a lot about that. I like to call it political noise, because a lot of times we hear about these things and then nothing ever happens. Do you see it as that, or do you think we're going to see some material changes in the way that retirement capital flows and kind of easing that up and being able to unlock that?
I think you're going to see meaningful changes. So I'll go back to that 46.8 trillion number, which is the rough estimates from Cerulli and Associates. That's data back from fourth quarter of 2025. That particular money, so let's think about the math here. 46.8 trillion, 99% plus is invested in stocks, bonds, and mutual funds. So that means they're invested in some public bond or some public company, okay?
Yep.
If 5, 10, 15, 20% of that, let's use the number 25%, so future state number, let's say 10, 15 years, and the number doesn't change. The 46.8 trillion obviously grows all the time because it's investment money. And this number is up from like 20 trillion like 15 years ago, because people save more and the stock markets continue to go up. So 25% of that would be roughly $11.5 trillion. What would happen to the United States, because these are all U.S. accounts, if $11.5 trillion in new money were redeployed into, let's say, the largest part of private investments is real estate. Now, to buy properties, to do development. I mean, we don't talk about this on this particular show, and this isn't my particular realm, but, you can flip on Bloomberg and probably see that there's a national housing shortage right now.
Right.
And so forth. So a redeployment of $11.6 trillion of equity capital would have a significant tidal wave effect on the U.S. economy, whether if it went into real estate. What if it just went into funding small businesses in the form of direct loans or helping businesses get equity so they don't have to access lending capital, right? I mean, that's a big, big difference here. So this would lessen people's reliance on having to borrow from, let's say, banks. And if you really look, I mean, the top 5 banks from U.S. Bank to JP Morgan control a meaningful percent of the market. And then from 6 to 25, you're now controlling like 95% of the U.S. banking market, and those are the people who lend to these businesses to try to grow. What if they didn't have to do that and they were able to access, let's say, a TribeVest deal and get connected to another local business on the other side of town? So now you have ownership all within the same town of that particular money. In other words, the money doesn't leave town. That's the problem right now. This $46.8 trillion is held by the average American, but it actually goes into the coffers of investment company firms, which are largely based out of Boston, New York, and then back to those companies in the form of owning their shares. If some of that money were redeployed, instead of leaving San Diego or leaving Austin, Texas, and redeployed to the other side of town to go buy rental property, you're talking about a massive effect if you drop $11.6 trillion somewhere.
Yeah, 100%. What do you think that modern portfolio looks like? Do you think it's going to be that mix of public and private? It's going to be kind of, but it's going to shift. It's going to take 10, 15 years to get there. But is that kind of what you envision the modern portfolio look like, instead of that 99% being in that limited number of public companies?
Yeah, and it will, because, I mean, to date, all smart money, so you referred to accredited investors, if you refer to institutional investors for basically all of modern times, so let's say the last 20, 30, 40, 50 years, they've always had a 50-50 split between public and private investments. And if anything, whenever they actually ebb and flow and change that allocation away from that number, they tilt higher privates and less public anyway. So in other words, it never goes 70% public and 30% private. When they drift to the 70%, that 70 is redeployed back into private at the expense of what they might have had in the public market. So yeah, I think that new modern portfolio is going to be like a mix, and it's going to happen slowly and then quickly. Overnight, it's going to change. And I think back to, again, I always look at maybe growing up as someone who, children of immigrants, I always kind of looked at the world a different way and tried to find out the why. But at my age, I remember that it was somewhere around the early 2000s that it seemed like, for a period there, was about 50% of people when they went into stores use cash, 50% use credit. And then in like 5 years after that, it's like 97-3. And it wasn't like gradual from that 50 to 97, right? It was all of a sudden, you got $20 bills in your pocket. Like, I don't even know what those are, type of thing. Like, in other words, it changed so fast. And I think this will be another one. Another one was that, it seemed like for 2 years, as rideshare was fighting it out with taxis, unless you were in Manhattan or Las Vegas, you saw like 50-50. You land in and out of the airport in San Diego. I landed in and out of the Austin. I actually don't remember the last time I saw a cab coming in and out of my own airport at my house. And I fly in and out of that thing like 3 times a month. And I was just talking to a buddy about this, that I don't see taxis anymore at all at the airport.
Yeah. Unless you go to New York, man. I went to New York. I'd taken like a 10-year hiatus that I had not been to New York City. And I think it was maybe like 3 years ago. I went back for a conference, and I was like, whoa, there's still tons of taxis here. This is the only place I see them.
That's the only place. But you go anywhere else, and this is the airport. This is a place where you'd expect to see them, right?
Right.
You don't see the line. It doesn't reference both. It references one. And either way, like, this was something that was kind of brewing, and then all of a sudden hit a tipping point, and you never went back. And there's a lot of things that that happen. I think another one, like you and I presumably are talking to each other maybe on laptops, not desktop computers, by units sold, not even close anymore. Smartphones without depressible buttons, not even close.
Yep. It's not like this. It's like
it was this way, and then it plateaued for a while. People were battling it out, and then next year, one died, the other one survived and thrived.
I agree. It's bubbling up right now, and it's gonna be exciting times. If someone, if someone wants to truly raise the bar in how they approach their retirement investing, do you have any lasting advice here for their first action step?
Sure. I think that first, just get organized. I mean, one of the things that we find is that people don't know where all their money is. And I know this isn't the case, but let's say the audience that would be listening to this, it's that you were busy living life and going from job to job and making rain and doing what you do. And before you became an entrepreneur, you worked at big law, you worked at this big corporation. And you think to yourself that you're spending more time to figure out where to take your partner to dinner this Saturday, Valentine's Day, as we record this, than you might have spent trying to figure out where you may have left a stray $20,000 account or $100,000 account at a past employer. So I think first is do the spring cleaning, but do it in sort of your financial life, right? We all do the sit down, unsubscribe from 100 different things at one point, but those are minimal effect things. I say go after the big rocks first, which might be to make sure that your accounts are all in one place. That's step number one. And then really determine, once you do that and you know your inventory, that are you invested in a way that if you didn't look at the accounts for 20 years, you'd be comfortable just leaving it there? And that answer is usually no at all levels of wealth. And if not, maybe think about what matters to you. And a certain percentage of those people might look at a provider like myself and say that, hey, this is getting to be a lot of money. I can't just let it sit there and operate in the background and not pay attention to it. It's X hundreds of thousands of dollars or X millions of dollars or X tens of thousands of dollars, which in all three scenarios is a lot of money to the person who holds it. And they might say to themselves that some of that needs to be in something that I feel like I have more control in.
Yeah.
A buddy's company, a real estate investment, and so forth, not this mutual fund that I only have because it was in the 401k plan of an employer that I don't remember the name of the company at this point because I worked there, 19 years ago, for example.
Yeah, I love it, man. Henry, it's been awesome having you on the show. Where can our listeners find out more about you?
So they can go to rocketdollar.com. There's lots of information. Even though we're a tech site, on the upper right of center, there's a phone number. So we do answer the phone. And that's just to answer questions and help you understand, hey, can I do alts? Does my IRA account, what's a 401k rollover? That type of stuff. We answer those questions. So it's rocketdollar.com, rocketdollar.com. The phone number is 1-855-ROCKET-D. So that's 855-762-5383. And then me, I might be the only Henry Yoshida to find on Instagram and LinkedIn. So if you want to connect with me and you think that my Costco analogies on how to explain the world are funny, hit me up there.
Love it, brother. Thanks, Henry. Appreciate you.
Thanks.
All right, that's a wrap. What Ben and Aspen Funds have built is not just a capital strategy, it's infrastructure. And that's really the takeaway here. When you move from raising capital deal by deal to building a repeatable capital aggregation model, especially across multiple asset classes and 40 plus ICAs, structure becomes non-negotiable. Compliance becomes non-negotiable. Professional administration becomes non-negotiable. Because once you scale past a certain point, informal arrangements, they really start to break down. And what replaces them is intentional design. If this conversation resonated with you, if you're a sponsor thinking about formalizing an ICA network, building a fund of funds program, or scaling your capital platform the right way, you need to sign up right away for the Institute for Structured Capital, the ISC. It's at TribeVest, our education and implementation platform specifically for sponsors, operators, capital aggregators who want to build compliant, scalable capital businesses. This is not a mastermind. It's not just a community. It's not about shortcuts. It's about understanding the rules of the game and hands-on construction of something that lasts. So if you're serious about professionalizing your capital aggregation strategy, you can learn more at www.tribevestisc.com. Whether you're early in the journey or already scaling, the difference between raising capital and building a capital business comes down to structure. And that's exactly what we focus on. Thanks for listening to the Best Ever CRE podcast. TribeVest Takeover Edition. I'm Seth Bradley, and we'll see you on the next episode. Thanks for tuning in to Raise the Bar Radio. If you enjoyed today's episode, make sure to subscribe, leave a review, and share it with someone who needs to hear it. Keep pushing, keep building, and keep raising the bar. Until next time, enjoy the journey.